This is Nightly Business Report with Sue Herrera and Bill Griffin.
Stocks rebound. The Dow soars more than 300 points as the bulls beat back the bears for control of this market.
Major obstacles why some of America's most beloved consumer brands are now attached to Wall Street's most hated stocks.
Private eye, the new role investigators are now playing in boardrooms across the country. Those stories and much more tonight on Nightly Business Report for this Wednesday, May the 30th.
Good evening, everybody, and welcome. What a difference a day makes. Stocks rocketed higher at the opening bell and really never looked back, recovering much of yesterday's losses. Bank stocks rallied, energy shares soared, and small caps hit a record as investor concerns over a political crisis in Italy faded. The Dow Jones Industrial Average advanced 306 points to 24,667. The Nasdaq was up 65, and the S&P 500 rose 34.
Oil prices also gained ground, notching their first gain in 6 sessions. A report that OPEC will keep crude production curbs in place at least until the end of this year helped reverse the commodity's recent slide on fears about higher production. Domestic crude rose about 2% today, settling above $68 a barrel.
Oil prices may have ended higher today, but they're down about 5% for the week. And the rise in rates that we've been telling you about have also begun to cool. So does this quickly changing narrative signal a pause or a fundamental shift in the market? Joining us to offer his insights is Sandy Villery, portfolio manager of the Villery Balanced Fund. Welcome back, Sandy. Nice to see you again.
Thanks, Sue.
So which is it? Is it a pause in an overall upside trajectory, or is it a fundamental shift in the way the market is valuing things?
No, I think it is a pause. Remember, we started the year at a 246 on the 10-year. We went all the way up to a 312, and now we're back to about a 285 on the 10-year. So I think that that's a little bit of a pullback, but I think rates, as the Fed continues to raise them this year, are going to put pressure, upward pressure on interest rates. And I think you're seeing that play out in the market. You're seeing that with small caps up about 7.5% year to date. They tend to do better in a rising interest rate environment versus large caps like the S&P that's only up about 1.5% this year. Remember, the larger cap multinationals in the S&P tend to export more expensive goods and services. So when interest rates go up, the dollar goes up, which again favors small caps. So I think small caps is going to be the place to be for the rest of 2018.
But, you know, there's a huge difference between investing in a rising interest rate environment and a declining interest rate environment. So especially if you're investing for income. So what's an individual investor who is looking for income to do right now, do you think?
That's a very tough question right now, because if you look at the 10-year and it was right around, let's say when it's right around 3%, that's one scenario. Then you have, on the other hand, some good income stocks such as Procter & Gamble and Kraft Heinz. These are all paying 3% dividend yields. But what you've seen in 2018 is investors now shifting as rates have come up and as bond rates have come up from the Procter & Gambles of the world to bonds. And so I think Procter & Gamble's down about 25% year to date. So I would have some exposure to stocks and bonds, such as in my balanced fund, where it's about 70-30 stocks to bonds.
On that note, thanks for the advice, Sandy. We appreciate it. Sandy Villery with the Villery Balanced Fund.
Well, one issue that still gets the market's attention is trade. And as we reported yesterday, the White House has revived its plan to move ahead with tariffs on some Chinese goods. And as Eunice Yoon reports for us now, the response from Beijing was swift and it was sharp.
President Trump's decision on tariffs isn't going down very well in China. Soon after the White House issued a statement, the Commerce Ministry responded, saying, "We are surprised by the strategic statement released by the White House, but at the same time, it is half expected." And today, the Foreign Ministry said, "In international relationships, every time you change, every time you break a promise, the country's credibility is damaged." Officially, both ministries said that China wants the U.S. to meet them halfway in the spirit of the joint statement. However, I spoke with one official on the Chinese side who's familiar with the trade talks, and he said that the most important thing that the U.S. and China need to do is establish mutual trust, but that this latest move isn't helping. The Commerce Secretary, Wilbur Ross, will be visiting China this weekend to continue trade talks. Advanced teams are here in Beijing to work out the details. The official said that the Trump administration's strategy appears to be to pressure the Chinese. As for whether China will retaliate, the foreign ministry commented on that, saying China doesn't want a trade war, but we won't hide from one. If the U.S. insists on being reckless, China will firmly take actions to safeguard its legitimate interests. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Meantime, a trade deadline looms with the European Union, another key trading partner. Tariffs on steel and aluminum imports are scheduled to take effect on Friday, and there are reports tonight that the U.S. will impose those import tariffs, and it comes as trade officials met on the sidelines of the OECD meeting in Paris. Shumana Bersetchi is there.
We're at the OECD forum in Paris, where today the OECD released their updated economic projections for the world economy, showing a growth rebounding to 3.9%. Now, this is the strongest period of growth the world economy has experienced in years. However, they have cited some clouds on the horizon, some risks that policymakers need to be mindful of, and one of them was trade wars. Now, this is coming at a very interesting time for Europe because on June the 1st, the temporary tariff exemptions that were applied from the US on EU imports are set to expire, and the expectation is that they may not be renewed. Now, on the sidelines of today's meeting, we know that Cecilia Malmström, who is the European Trade Commissioner, also met with her counterpart, the US Commerce Secretary Wilbur Ross, and did have discussions. However, neither one of them have commented on what the final tariff decision is going to look like. But in remarks earlier today, Mr. Ross did say that the EU is the only trading partner that have said that they will not be willing to engage in discussions so long as tariffs do end up getting applied. Now, of course, all of this comes at a time when policymakers have been discussing next steps on multilateralism and how to improve multilateralism to make it more inclusive and to make it more fair. For Nightly Business Report, I'm Shumana Bersetchi in Paris, France.
Meanwhile, economic growth was revised slightly lower here for the first quarter of the year. In its latest revision, the government said this morning that the economy grew at a 2.2% annual rate between January and March, down from the previous estimate of 2.3%. Economists say that businesses and consumers slowed their spending a tad, but most are expecting to see a solid rebound during this current quarter.
U.S. businesses added to their payrolls in May. According to the latest ADP survey, private payrolls grew by 178,000, thanks to strong hiring in construction, education, and healthcare. That report suggests that the job market remains healthy, but might be slowing just slightly as the pool of available workers dwindles.
The Federal Reserve is refining a rule that governs trading at banks. The central bank is proposing a change to the so-called Volcker rule that makes it less of a one-size-fits-all. The move would place the greatest restrictions on banks that do the most trading. Banks that do less trading would face fewer regulations. This rule, which is, as you know, a part of the Dodd-Frank banking law that was adopted after the financial crisis, has often been criticized by Wall Street as being too onerous and harmful to the functioning of the financial markets.
Well, the latest survey from the Federal Reserve casts an upbeat view on the economy. The Fed's Beige Book, which is an anecdotal look at the economy across the country, points to a moderate pickup in activity this spring. Hampton Pearson has more.
The latest Federal Reserve snapshot, the Beige Book, finds economic activity expanded moderately in late April and early May. Manufacturing really leading the way, shifting into high gear with more than half the districts reporting a pickup and 1/3 classifying activity as strong. However, on the other side, overall consumer spending was characterized as soft. And there were also some contacts from around the country noting uncertainty about international trade policy. All in all, it's part of what economists see as a mixed economy with some concerns on the horizon.
The good news is the Fed probably doesn't have to move super fast to raise rates. Now, they're going to almost surely raise rates in June. But of course, if they go too fast, that's when the market gets nervous.
But it's still all about labor markets. They remain tight across the country, with reports of difficulties filling jobs across a variety of skill levels. Shortages of qualified workers, including truck drivers, carpenters, electricians, even information technology professionals. Of course, many firms responding to those talent shortages by increasing wages and compensation packages. But however, the Fed still says overall wage pressures in the aggregate remain modest. That's leading economists to see no alarm bells for the Fed when it comes to future monetary policy.
Wage growth has been extremely modest relative to other times when we've had economic expansion post a crisis and recovery period.
The next and perhaps most important economic barometer just 2 days away, the all-important jobs report from the Labor Department on Friday. Hampton Pearson, Nightly Business Report at the Federal Reserve.
Time to take a look now at some of today's upgrades and downgrades. Dow component Apple was downgraded to hold from buy at Maxim Group. The analyst there calls the optimism over Apple's services business overblown and says the company's subscription business will disappoint investors. Price target now $200. That stock fell a fraction to $187.50. Fellow Dow component ExxonMobil saw its rating raised to outperform from sector performance RBC Capital Markets. The analyst cites the acceleration of the company's investments in new energy products. The price target $100. The stock rose nearly 4% today to $81.50.
AK Steel was downgraded to sell from neutral over at Goldman Sachs. The analyst there cites increased competition with its automotive business. The price target is $4. The stock closed just above that level at $4.58. Target was added to Bank of America's top ideas list. The analyst says the retailer will benefit from aging demographics. The price target is $86, and the stock rose more than 2% to $73.47.
Still ahead, the future of the media industry, according to those who run it.
Consumer Reports reverses its recent decision and will now recommend the Tesla Model 3. The magazine says a recent update improved the car's braking distance by almost 20 feet. The Model 3 braking performance prevented the car from initially getting a Consumer Reports recommendation. But today's move helped lift Tesla shares nearly 3% to finish the trading day on the upside.
There is a new perk for Walmart employees. The retailer is now offering pay for its workers to go back to school, as long as they get degrees in business or supply chain management. The country's largest private employer is partnering with 3 universities to offer these degrees to nearly 1.5 million part-time and full-time employees. As the labor market tightens, Walmart clearly is hoping that the program will keep those employees at the company. The benefit was announced today at the start of Walmart's annual shareholder meeting.
At Amazon's shareholder meeting, CEO Jeff Bezos acknowledged that the company has come under intense scrutiny this past year and that more scrutiny is expected as the company grows. Protesters gathered outside the meeting, pushing for the appointment of an independent director to the board. A shareholder proposal to split the CEO and board chair positions failed.
21st Century Fox shareholders are going to vote on the proposed merger with Disney on July 10th. That puts pressure on Comcast to make a formal offer for Fox's assets. That deal and the future of the fast-changing industry was just one of the topics at the Code Conference, which brings together the biggest players in the business. Julia Borston is there for us tonight.
With leaders of the biggest media and tech companies taking the stage at the Code Conference and a range of media mega deals pending, the question of why there's pressure to consolidate loomed large. 21st Century Fox CEO James Murdoch saying they see so much opportunity in having greater scale. When pressed on Comcast's plan to make a higher bid for Fox than Disney, he focused on progress on Disney's acquisition.
Essentially, we had an agreement with Disney, and we have an agreement with Disney, which we find very attractive for our shareholders. It's an all-stock agreement. We think the prospects for the new firm are very strong, and we think from a regulatory perspective, and we thought as well in December from a regulatory perspective that you have a higher a higher certainty of close. So when you weigh up all of those factors, that's really what we thought was the right thing to do. Now, whether or not the board is asked to consider a different offer from somebody else in the future, we'll deal with that as we go.
With AT&T awaiting a judge's ruling on whether it'll be able to buy Time Warner, AT&T CEO Randall Stephenson saying consolidation is inevitable.
Nobody really knows what the future is going to look like 5-6 years from now, but I think the bet that most people are making is premium content is going to be very, very relevant 5 or 6 years from now. A lot of bandwidth is going to be required to make all of that happen. And there are going to be new kind of business models surrounding this, particularly as it relates to ad-driven type business models.
With AT&T looking to grow as it feels pressure from big tech, one of those big tech companies, Facebook, is feeling the heat here at the Code Conference. Fox CEO James Murdoch criticizing Facebook ads and how it's been used as a platform for manipulation. Snap CEO Evan Spiegel took a dig at Facebook for copying its features, but not for copying its more stringent data protection policies.
What they've done is they've changed their products, and I think they actually changed their mission, right? But I think fundamentally, they're having a really hard time changing the DNA of their company. And the DNA of their company is all about having people compete with each other online for attention.
Facebook COO Sheryl Sandberg on stage with CTO Mike Schrepfer responding by saying they're taking responsibility and investing big, even though it will hurt their bottom line, to make sure this doesn't happen again.
We can get better. We can be more transparent. We can put a lot more resources and a lot more thought, both technology, automation, and people.
Sandberg and Schrepfer also talking about all the changes they've made in the past 2 months and the ways they're complying with new European privacy regulations. For Nightly Business Report, I'm Julia Borston in Rancho Palos Verdes, California.
Sales impress at Dick's Sporting Goods, and that's where we begin tonight's market focus. The retailer reported stronger than expected earnings and revenue, quelling fears that business performance would be impacted by the company's decision to stop selling guns. In fact, Dick's said it thinks new customer visits have increased as a result of that policy. The company also raised its earnings guidance for the full year, and the shares jumped nearly 26% to $38.35. Michael Kors reported earnings that topped expectations, but the handbag maker's full-year profit outlook sparked some concerns. The company said increased investment in its Jimmy Choo brand would be cutting into its earnings growth in 2018. So the shares sold off, down more than 11% to $60.41. And DSW grew its sales and improved its margins in the latest quarter. The shoe retailer also said it launched a new loyalty program that it hopes will generate additional growth. The company didn't update its earnings guidance specifically for the year, however, and that disappointed some investors. DSW shares finished down more than 5% to $24.61.
Watchmaker Movado said that strong demand for many of its brands helped overall sales edge past expectations. The company added that e-commerce performance was a bright spot for the company in the quarter. Movado also raised its full-year earnings forecast. Shares ticked higher by 16% today to finish the day at $49.20. And after the bell tonight, cloud software company Box reported a narrower than expected loss and higher revenue. Company also gave guidance for the current quarter that was ahead of street estimates, but still, shares initially traded lower in the extended session, erasing a more than 1% gain that we saw when shares ended the regular session at $27.78.
Big consumer brands are facing unprecedented challenges. We've been telling you about familiar names, most recently Campbell's Soup, that are seeing sales slide as they struggle to keep up with changing consumer tastes. Tonight, Sarah Eisen takes a closer look at the stumbles that have put these well-known companies on the defensive.
Many of America's best-known brands are hurting. From Playtex to Palmolive, Cheerios to Velveeta, they're facing real questions about how to stay relevant. Take Campbell's Soup, which is now in the middle of a strategic review after the abrupt retirement of its CEO, Denise Morrison. It represents a lot of what's going wrong at consumer companies, like missing key insights about their customers, such as the shift to eating soup as an appetizer instead of a main course. The company didn't innovate enough to address the change, according to industry insiders. Other companies have tried to catch up by buying successful smaller brands that are growing, like General Mills buying Annie's, known for its organic mac and cheese, or Campbell's Soup buying Bolthouse healthy drinks. But they haven't managed to learn from their acquisitions. Instead of integrating the startup cultures into their existing products and processes, The companies have absorbed the startups into their existing bureaucratic cultures. They also haven't been able to hold on to top talent and founders after a few years of a transition, missing the opportunity to have successful entrepreneurs who founded disruptive startups. And the problem is bigger than just losing touch with their customers. The big brands are also getting squeezed by a war between retailers, with Amazon's Whole Foods, Kroger, Walmart all slashing prices to compete, squeezing food margins. But some venerable brands are managing to change with the times. ConAgra, for instance, has managed to revitalize its frozen food business.
Think about what frozen entrees were 10 years ago. We still called them TV dinners half the time. Now, you go around, you'll see these power bowls. The bowls themselves are made out of biodegradable material. Companies like ConAgra have done a terrific job of making those brands more relevant for consumers.
Estee Lauder, Coca-Cola, and Unilever, according to analyst Ali Dabaj of Bernstein, have all managed to stay relevant with the consumer as well and have done a better job integrating acquisitions and learning from them. Unless companies start to adjust, this is a group that experts say could feel more market pain, see big deals to cut costs and spin off brands, and many will be holding on to the past. For Nightly Business Report, I'm Sarah Eisen.
Now, as a result of those missteps, investors no longer love consumer staple stocks. They're turning their backs on this once popular sector, and Mike Santoli has more for us on that tonight.
Shares of the biggest packaged food and household product makers, once considered safe and stable blue chips, are among the worst performers this year. Campbell's Soup, General Mills, and Kraft Heinz are down more than 20% in 2018, compared to slight gains for the broad market. Only a small minority of analysts are recommending most of these stocks, worried that recent declines in sales will only worsen as their commodity costs rise and younger shoppers shun traditional supermarket brands in favor of trendier, more natural offerings. Just 2 years ago, these consumer staple stocks were favorites of investors, coveted for their generous dividends compared to low bond yields, and cherished for their resilience in a slow-growing economy. Today, the focus is on a humming U.S. economy and companies managing to grow profits rapidly. This leaves a value-minded investor with the question of whether these stocks have become cheap and neglected enough to represent bargains. Based on projected earnings for the coming year, Campbell's, General Mills, and Kellogg have not been this inexpensive relative to the broad market for more than 15 years. Procter & Gamble and Clorox are cheaper than they've been in more than 7 years on the same basis. Looking cheap is no guarantee that the pain is over for investors in these stocks, of course. Buying them now is a bet that companies can freshen their brands to win over younger customers or improve results through mergers and acquisitions. And, correct or not, that's a bet the Wall Street crowd is increasingly unwilling to make. For Nightly Business Report, I'm Mike Santoli.
Coming up, executive search takes on a whole new meaning now that private investigators are involved.
Sir Martin Sorrell is starting a new venture. The founder and former CEO of advertising giant WPP has taken control of a shell company in London with the hopes now of transforming it into a new marketing services business. Now, that's the same strategy that he used years ago to build WPP, the company from which he resigned abruptly just 6 weeks ago. That departure occurred during an internal company investigation. The results have yet to be disclosed.
And there is a new player in corporate boardrooms, the private investigator. They're being used to look into executives' pasts, and by doing so, they are altering the future of some companies. Leslie Picker explains.
In the Me Too era, allegations of predatory behavior bankrupted Harvey Weinstein's company and forced out Wynn founder Steve Wynn, sending the stock on a roller coaster ride. The stakes are high for corporations failing to root out sexual harassment, so they've turned in droves to private investigators.
An ounce of prevention really is worth a pound of cure here, because the cost, both in terms of potential drop in stock price, legal and PR costs, the possibility of the regulators getting involved in regulated industries, they're enormous compared with the relatively modest expenditure in hiring folks like us in order to rule out this behavior.
Nardello, a private investigator for 25 years, says he's seen about 35% more client calls related to sexual misconduct over the last 6 months.
I have never seen a societal phenomenon that has had the impact on our business as the Me Too movement and the post-Weinstein world.
He says corporations and private equity firms are looking for help in due diligence ahead of acquisitions. He's also looking into the backgrounds of potential board members and C-suite hires. And some clients are seeking possible predatory behavior in competitors, a move that one of his clients calls weaponizing feminism. Nardello often gets work through lawyers like Ed Little, who recently sought help clearing the name of a client who had been accused of sexual misconduct.
The Me Too movement is a very valid movement, but there's been overreaction, we believe. And so in representing somebody who's been accused, it's important to find out whether or not there's any credibility to the accusations.
Nardello's number two, Sabina Menschel, walked me through their client offerings, starting with online searches.
Databases like these that we have access to, some of which because we're private investigators, and they allow us to search for publicly available information. But we always complement that as well with what we call on-site searches.
Menschel says on-site searches include sending investigators to where the subject has lived or worked, searching local databases like county court records, and knocking on doors to interview neighbors and friends. And the work is making a difference. Nardello says he's seen private equity firms walk away from deals and companies decide against hiring individuals after discovering sexual misconduct. Despite the wave of allegations of predatory behavior during the Me Too movement, Nardello says we may have only seen the tip of the iceberg. For Nightly Business Report, I'm Leslie Picker.
Before we go, one more look at today's rally on Wall Street. The Dow was up 306 points, NASDAQ up 65, the S&P up 34.
And that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.